Mutual fund taxation. These are the topics we are going to see. Dividend distribution tax, capital gain tax, and again in capital gain tax we will see about short term capital gain tax, long term capital gain tax, then we have TDS and we have STT, securities transaction tax. So let us start with dividend distribution tax. So what is dividend distribution tax? See here, dividends are tax free in the hands of investors. It means that once investors receive dividend, it is completely tax free. But before dividend distribution, the AMC will pay tax to the government. That is known as dividend distribution tax. To put it, if rupees 10 is the dividend, you will not get entire 10 in your hands. In the sense, AMC will pay tax to the government, then the remaining shall be given to you. So this is the concept behind dividend distribution tax. And let us see the rates also. See here, equity funds are completely tax free. In the sense, in case of equity funds, there is no dividend distribution tax. So the entire dividend you will get. The AMC will not pay any tax to the government. Whereas in case of non-equity schemes, dividend distribution tax is applicable. See the slide and you will understand that. And in case of individuals or HUF investors, there is a tax of 28% for dividend distributor. And in case of corporate investors, there is a tax of 34%. It means that AMC will pay this tax and the remaining is given to you as dividend. So this is dividend distribution tax. And coming to the next topic, capital gain tax. So what is capital gain? Capital gain is the profit you get from mutual fund units. And again, capital gains, we have taxation is divided into two types. We have equity taxation and we have non-equity taxation. So let us start with equity taxation. And before that, you should understand we have short term capital gains and we have long term capital gains. So what is short term capital gains? In case of equity schemes, short term capital gain is any profit you receive before completion of 1 year from the purchase of units. So you bought units and you redeemed within a period of 1 year, then whatever profit you get is known as short term capital gain. And we have long term capital gain, which means that any gain arising out of sale of units after a period of a year, that is known as long term capital gain. And in case of equity schemes, short term capital gain is taxable at a rate of 15%, whereas long term capital gain is completely tax exempted or tax free. And coming to the next one, non-equity taxation. And here is a change in the sense, short term in case of non-equity schemes is a period less than or equal to 3 years. So any gain arising before 3 years is known as short term capital gains, and long term is after completion of 3 years. And in case of non-equity schemes, non-equity in the sense it can be any scheme other than equity. It can be a gold scheme, or it can be a debt scheme, or it can be a hybrid scheme, or it can be MIP, etc. So any scheme other than equity comes under non-equity category. So in case of non-equity schemes, short term capital gain is added to the income of the investor and is taxed as per the slab. This is known as marginal tax. And in case of non-equity schemes, long term capital gains, that is after a period of 3 years, whatever gain we get is taxable at the rate of 20% after indexation. So this is the method we follow. So short term capital gain is taxable as per the slab of investor, we call it as marginal tax rate, and long term capital gain is taxable at the rate of 20% after indexation. So this is about the taxation part, and we will see about indexation in the coming slides. So let us start with indexation. So what is indexation? As is seen in the slide, indexation is nothing but inflation adjustment for inflation, and this inflation figure is provided by an index known as cost inflation index. We call it as CII. The numbers are published by Income Tax Department. So every financial year we have a separate number. So let us see with an example, you will understand. See here, a purchase happens in the financial year 2010-11 and you are purchasing units worth rupees 100. And after 3 years, that is, you redeem the units in the financial year 16-17, that is after a period of 6 years, and the redemption amount is 150. So the said transaction can be classified as long term in nature because the period under consideration is more than 3 years. We have around 6 years in the given example, and you have bought units for rupees 100 and you have redeemed units worth rupees 150. So there is a total profit of 50 rupees. But what is the capital gain tax we have to pay? So this is what we are going to see with solution, and before that you should understand, you should remember the number given, that is the cost inflation index number. See, the cost inflation index number for the purchase year, that is financial year 2010-11 is 711, and for the financial year 2016-17 the number is 1125. It means that the number has increased from 711 to 1125. This is due to inflation. This is inflationary impact. We are taking into account this impact and we are going to calculate tax. This is what we are going to see in the next slide. And again, see here, first of all we should calculate indexed cost. In indexation, we should first calculate indexed cost. So what is indexed cost? Indexed cost is nothing but adjusting the cost price. Cost price is our purchase price. Adjusting the cost price for inflation. And what is the formula? See here, purchase price multiplied by CII, cost inflation index number of the year exit or the year during which you redeemed your units. You will get an answer and you divide it by the cost inflation index of the year entry or the year during which you bought the units. And we have in our example the purchase price is rupees 100 and the CII of redemption year is 1125, that is we redeemed in the financial year 16-17. So 100 multiplied by 1125. You divide the answer by the CII of year bought, that is the entry year, that is 711. Now you get the answer as rupees 158. Rupees 158. This answer is what we call as indexed cost. Indexed cost. Now coming to the profit part. So what is profit? Profit is nothing but selling price minus cost price. This is the formula for profit. Profit is nothing but selling price minus cost price. But here there is a small difference. Instead of using the original cost price of rupees 100, we will use indexed cost price of rupees 158. So what is profit here? Profit is nothing but selling price, that is rupees 150, minus indexed cost price, that is rupees 158. And the answer is minus 8. It means that it is a loss. The above example says that it is a loss. The given transaction has resulted in a loss. So this is the advantage of indexation. See, actually speaking, we have a profit of 50 rupees, but after indexation, it becomes a loss. This is the impact of inflation. This is the impact of inflation. So this is the advantage of indexation. Say assume, let it be a profit of 10 rupees. Assume, okay. Here actual case is there is a loss of 8 rupees. But forget about that. Assume that there is a profit of 10 rupee. After indexation, there is a profit of 10 rupee. So now what is the tax? 20% of this profit. 20% of the profit after indexation. So if we assume profit as 10 rupees, then 20% of this profit, that is rupees 2, will be our tax. So this is an example to show you how indexation works. I hope you would have understand about indexation and other concepts. Thank you.